entities in Wyoming that have the fiscal year ending June 30th, that's going to be June 30th of 2019. That's going to be your base year. Then you'll determine your revenue growth rate, and this is based on the average annual growth rate of the last full 3 fiscal years prior to January 27th, 2020, or 4.1% as allowed by the guidance. So you can select the higher of the two. Step 3 would be to apply the growth rate from the end of the base year to the first point in time calculation period of December 31st, 2020 to obtain your counterfactual revenue amount. And then you'll identify the actual revenues collected over the past 12 months as of the calculation date. So for your base year and your 3 years to calculate your average, you are using a fiscal year basis. In step 4, you're using a calendar year basis. So you'll identify your actual revenues from January 1, 2020 through December 31, 2020. As Justin mentioned, that there are revenues that are allowable and some that have to be excluded. So the revenues to include would be general revenues as defined by the U.S. Census Bureau, federal, state, and local government Finance and Employment Classification Manual. It includes revenue from other governments and from the state, sales and gross receipt taxes, property taxes, licensing and permit fees, severance taxes, user fees and charges, sewerage charges, refuse collection, disposal, and recycling charges, fines and forfeitures, and other miscellaneous revenues such as interest earnings, receipts from the sale of property, rents, royalties, and private donations. So the revenues that have to be excluded include revenue directly from the federal government, revenue from the state financed from the federal government, which this can get a little confusing in some cases, particularly with Wyoming Business Council and State Lands and Investments grants, because sometimes those grants are actually federally funded that the state is passing through. So if you do have grants from those entities, you'll need to take a look at the grant documents and see if they are actually federal funds. We also exclude water supply system revenues, electric supply and gas supply, and transit or bus system revenues, proceeds from the issuance of debt, trust revenue, and refunds or other correcting transactions. So to get this information, you'll want to review your chart of accounts for revenues that can be included in the calculation. So you're going to look at revenues, actual revenues for the fiscal years ending 2019, 2018, 2017, and 2016. You'll want to look at the U.S. Census Bureau manual to determine which revenues are considered general revenues. And I have the website listed here on where you can find that document. Then you'll want to classify your revenues into the allowable categories and calculate your fiscal year totals. So there's a few ways that you can do this. You can create a spreadsheet to enter your data and formulas to calculate your revenue totals and your average growth rate. Then you can enter your base year total revenue and growth rate into the WAM website calculator that's on there, or on their website. If you are a member of GFOA, they have a very detailed revenue calculator available to members, and you can access it through your login in GFOA. And one thing that I found helpful is for those of you who file the F66 City and Town Financial Report every year, you can utilize the worksheet that they provide in Excel to classify your revenues. In the actual Excel worksheet, it includes the U.S. Census Bureau revenue codes. So you can look at the revenue codes on the F66 report and compare them to your U.S. Census Bureau report and determine which ones you will include. Even if you don't actually file the F66, you can still download that worksheet from the Division of Public Funds website, and that will at least get you started with classifying your revenue. So that's another easy way to do it. This is an example of the F66 worksheet and the U.S. Census Bureau report. So as you can see, the first line on the U.S. Census Bureau report is property taxes with a code of T01. And you'll see on the F66 worksheet, under the property tax assessed at local level, they have the 3 different categories for T01. So you could take this Excel spreadsheet, fill in your information from your revenue data for all 4 years, and then this will help classify it for you. So the second step is to calculate the average growth rate. So what you'll do is you will have your 4 years of revenue, your base year, and then your prior 3 full fiscal years that you are calculating your revenue growth. So in this particular example, in fiscal year ending June 30th, 2017, there was a 0.6% revenue loss. As of 2018, it was a 9.7% loss. And then in 2019, our base year, there was a 2.4% growth. So what you want to do is take your average. So to get your growth rate, for example, for fiscal year ending 2017 of the minus 0.06, you're going to take your 2017 actuals minus your 2016 actuals divided by your 2016 actuals to get your growth rate. And then you're going to take those 3 numbers and average them. So in this particular case, the average growth rate would be a minus 2.6. Since the guidance allows for using the higher of your actual growth rate or 4.1%, in this case, we're going to take the 4.1% for our calculation. Then you need to calculate your counterfactual revenue. So you're going to take your base year revenue and your growth rate, calculate your parentheses first. So you're going to take 1 plus your growth rate. You're going to take the number of months from your fiscal year end date for your base year through the calculation date of December 30th, 2020, and then divide that by 12. That gets you your 1.5. And then you're going to calculate your exponent. So using the Excel formula function to calculate your exponent is a much easier way than trying to do it by hand. So what you get is your 1.041 with an exponent of 1.5 that gives you 1.062126. You take that number, multiply it by your base year revenue, and that gives you your counterfactual revenue. So that's basically an estimate of what you would have had in revenue if COVID-19 hadn't affected your finances. Obviously, that is just an estimate based on the figures that you are collecting and the growth rate that's being used. So in step 4, then you need to identify your actual revenues. So again, review your chart of accounts for the actual revenues for the 12 months prior to the calculation period, which is going to be January of 2020 through December of 2020. Classify the revenues into the allowable categories, just as you did in step 1. And then to calculate your revenue loss, you're going to take your actual revenue minus your counterfactual revenue that you calculated in step 3. And if your actual revenue is less than your counterfactual revenue, then you have a revenue loss that you can use ARPA funds for. If your actual revenue is higher, then there is no revenue loss. The U.S. Treasury website has a variety of information and documents that is helpful, I think, to the non-entitlement units. I do have their website listed here, and then just a screenshot of the various documents that they have on their website. So you can get additional information on the frequently asked questions, methodology, overview of guidance, variety of information. They do update their information whenever they have additional Q&As that they put out. You can also subscribe to get updates from the U.S. Treasury. So whenever they have changes to the NEU guidance, you will receive an email with those changes. So it is a little bit of a complicated process, but I think if you break it down into steps, And then you just go step by step, calculating your revenue, getting that information in, then you can just plug your figures into that little calculator on the WAM website. Or if you want to use a more extensive calculator and you are a GFOA member, you can go to their site and use their calculator. So that's what I have for you today. Justin, I don't know if you want to open it up to questions or how you would like to proceed next.
Sure, Leslie, if you have, if anybody's got any questions, feel free to chime in. Leslie, there's a couple of folks that are in the waiting room too, and unfortunately, it's the host.
I just admitted one.
Okay, perfect.
Yep, I saw the little message come up, so I just admitted one. Is there anybody else out there waiting that you can see?
That's what I see so far. Julie, this is being recorded, so we'll I'll work with Leslie, you know, to get the PDF, but we'll also have the recording available too.
Okay. Oh, yep, I do see in the little chat that about sharing the PDF, and yep, I will absolutely email this to Justin so he can get it out on the WAM website. And then I'm available if you'd like to call me if you have any questions. I'll do my best to help. I know the guidance is still evolving and there may be changes as we go forward, and there's a lot of different interpretations regarding the revenue loss calculation and as far as what revenues to include. So I've tried to be, I guess, make it a little simpler than some of the guidance that's out there in all of the steps to take to get the numbers that you need.
Leslie, do you mind there on the right, if you find my name in the list, there should be a button that says more, if you could shift the host.
Let's see. I have a record, reactions, disable, hide, nothing for shifting the host. This part is new to me. I've not been a Zoom host before.
Oh, you're okay.
Oh, wait, give keyboard and mouse control to Justin? No? Share. Okay. Okay, I'm not finding anything to transfer it back to you.
That's okay. I can.
Sorry.
No, that's fine. Technical difficulties. I apologize for that. I think that was in the meeting settings when I originally scheduled the meeting. So, so a couple of things that Leslie touched on that I did want to go ahead and expand on a little bit. I talked with Beth Blackwell yesterday from State Lands and Investments, because obviously one of the big questions that most folks have when they're trying to figure out your revenue number, obviously, if it's non-federal money, it counts against that revenue. So government to government transfer, as long as it's not federally based. A lot of grant programs and whatnot, that can be a little tricky, especially if they're administered locally. So I did get a hold of Beth Blackwell, loan and grant manager with the State Lands Investment Board, to clarify, because obviously one of the biggest, kind of broadest based loan and grant programs, or at least administers here in the state that most of you have had some, whether or not you're getting funds from them currently or in the recent past, would be through SLIB. What she got back to me with is there's only 3 programs that if you're receiving funding from SLIB for these programs, that would actually not count towards your revenue number. Any CARES Act money that was approved through CRF or CRG through the SLIB board. So any CARES Act dollars that you applied for that you've received payment or that you received payment in that that initial in either of the revenue years. Either base year you wouldn't have, but obviously in this 12-month collected revenue year. So those you could take out. So if you received any CARES Act money, and then the other two programs were the Clean Water State Revolving Fund and the Drinking Water State Revolving Fund. So if you received monies for either of those two programs, those you could go ahead and take out of your revenue number. The other, and Leslie hit on it fairly quickly, but in reading through the guidance as well as the FAQs from Treasury on this particular subject, the one thing that's kind of confusing is your utilities. As she mentioned, wastewater, so your sewage treatment, as well as solid refuse, so your trash service, both count as revenues. The clean water or your water treatment for drinking water does not. So you've kind of got to split hairs a little bit. The other ones that don't count that a few of our communities do have as well are electric. And if you provide natural gas as a utility as well. So clean water, drinking water, if you have an electric utility or if you provide gas utility. So those three would not be included in the revenues, but your wastewater, so what you charge for sewer, and your trash collection do count. So a little confusing how that sort of splits hairs between the two. But again, please read the FAQs. That was kind of the homework that I had hoped to pass out this week a little bit as we go towards next Friday's presentation. If you look on the WAM website or on the Treasury website that Leslie had provided the link for, look for that FAQ link. Go ahead and print that guy off. It's 42 pages currently. As she said, it grows all the time as they get more questions and provide more answers on that. Go ahead and print that out fairly quickly off the top of it. I think it's about the third subsection. You'll see all the FAQs specifically on this lost revenue calculation. That's really good information to have. And I think it gives you a pretty good framework, as well as the guidance itself, which you should all, whoever is going to be in kind of as Auditor Racine made the suggestion at summer conference, realistically, every town should have somebody who's kind of concentrating on this and is doing their best to sort of make themselves a bit of a subject matter expert on it. It is some work. There's some reading involved. I've been doing all of that so that it can hopefully be as much of a resource as possible, not necessarily being a fiscal person by nature, but there is, like I say, a good understanding of these rules is going to pay dividends as you move through the process of identifying where you want to spend these dollars. Again, this lost revenue calculation, these dollars, if you're able to, whatever dollars you can identify through that, those dollars are going to be much more, they will have way fewer strings attached as far as what they can be used for. As Auditor Racine mentioned in her presentation, basic operations of government really are all allowable. You can't pay off debt. You can't throw it in a rainy day fund. You can't, pay into a pension program. There are just a few rules, but as far as like general operations, it really kind of opens it up as long as those dollars, like I say, can be run through this lost revenue calculator. The other thing, and in having a conversation with Auditor Racine yesterday, I asked the question about timing. Obviously, you've got two tranches of money coming, the one that you just received or will be receiving very shortly, and the one that'll come in a year from now. I had several questions about the lost revenue calculation and how that would apply over time. And her answer to me was, if you have a lost revenue number, even from just this first year, which we have some communities that saw pretty drastic drops in revenue, that it would account for your entire allocation over the two tranches, then that's fine. That can be used for both of those. But say it's a partial application this year. So say you were getting, just round numbers, you were getting $20,000 in ARPA funding and you could show $10,000 in loss, you would still have that other 10,000 that has to be spent within the guidance and wouldn't be allowable for some of those broader base uses in general government operations. But next year, you're allowed to do this calculation again for the tranche that comes out next year, and or if you had any remaining from this first year. So they know, and the explanation for that is that they know the effects of the kind of the ripple effects of the pandemic. A, some of them are delayed, and B, some of them will be ongoing. So if you continue, and again, you don't necessarily have to show loss to claim loss because of the 4.1% that they're assuming as growth. If you didn't have growth greater than that, obviously by the 3 fiscal year rule that Leslie was illustrating. So say you break even over the next year, basically year over year, you could still go back and recalculate in that 4.1%, assuming they don't change that percentage, but we don't have any indication that they will. But a year from now, you could recalculate that for the calendar year we're in currently. So another interesting thing that would require a little bit of patience as far as your spending of the dollars, which of course, and as we've stressed in the past, this isn't nearly the fire drill that the CARES Act money was from a time standpoint. The monies don't have to actually be appropriated towards or attached to a specific project until 2024, and then that the monies have to actually be spent by 2026. So say if you were doing brick and mortar construction or a utility project that falls under the infrastructure provisions of it, you've definitely got some time to get those completed. So again, lots of interesting ins and outs and lots to learn, kind of not only in perpetuity, but just kind of in continuum too. Seemingly every time I think I've caught myself up on my ARPA reading when it comes to from Treasury, all of a sudden something else hits my inbox, either directly from them or something that's filtered through National League of Cities. So again, we'll do our best from the WAM side to continue to provide these educational opportunities, but we wanted to start with first things first with this lost revenue, so that you folks, everybody could go through this calculation to know what they could write off to the lost revenue piece, and then we're going to start to walk into the guidance and really starting to talk about what specific types of projects, what specific types of expenses that you can put this money towards. So again, with that, I guess a little bit of homework before next week's meeting on Friday. I'm working on getting a couple different folks to be on there with me for next Friday. So stay tuned for a bit of an agenda. Hopefully later today, I'll be able to let you know who we're going to talk to next Friday for sure. But do read through that FAQ. That also, we've got that first 35-page document that not only rehashes some of the guidance, but also starts to talk about some of the reporting. The first reporting is actually due for our 2 bigger communities right here at the end of the summer, and everybody else, the very first report that we have to get into the feds falls right at the end of October, on October 31st of this year. So it'll be here before we know it. And if anybody's actually able to get any of these dollars spent, and also too, if you're doing this lost revenue calculation, if you're able to slide those dollars over into your general funds based on that, then of course you'll report on that in that October 31st window as well. So, which, as Auditor Racinas was quick to remind us, doesn't actually kind of end the tracking of those dollars. So even if those do slide into your general government's account for general government purposes, you still have to report where those dollars, were effectively spent, keep an accounting of where those dollars were used within your budgets, even though they don't necessarily fall under the stricter guidance spending rules. So again, like I say, a lot to read, a lot to learn. Be sure to check out the ARPA resource page. I'm trying to keep that absolutely as up to date as I possibly can. I'm trying to watch the Treasury website every single day because, like I say, a lot of those documents, especially the FAQs, are just in a constant state of evolution. So trying to make sure that we've got links to the latest and greatest. And as Leslie mentioned, if you're willing to get a little bit of mail in from the federal government, subscribing for updates on that is an excellent tool to just make sure that you don't miss anything, because it is going to be a constant stream of information here for the next little bit. Did anybody have any other questions?
Justin,
Yeah,
I have a question.
sure.
So in her presentation, the auditor's presentation last week, she mentioned something about taking that 4.1% and then multiplying it by 1.5, and you end up about 6. Or could that be elaborated upon what that meant?
Yeah, so that's what Leslie was showing in her calculation there too. So the 4.1%. Now the other difference, the 1.5, is actually that part of the calculation is coming from months. So it's 18 months since technically the beginning of COVID, but they're actually only looking for your actual revenues for the last 12. So that's where that number that plays, or that 1.062126 that she's got on the screen there. That's where that number's coming from. So they're actually, how it kind of works is they're actually allowing even more buffer than the 4.1%, because they're not asking for your revenue over the whole 18 months. They're only having you use the revenue that was generated over the last 12, even though for your counterfactual revenue, they're calculating it on 18.
Okay. And then, thank you. So if after all of our learning and all of this, we still have technical questions, is there someone we can call?
Yeah, feel free to shoot me an email or shoot me a call. If it's something that I don't have a good answer for, I will put you in touch with folks that can be helpful.
Okay.
Like I say, this, if you go on the WAM website, that calculator that's available there that Leslie developed, it's just an Excel spreadsheet. It happens to have Cody's numbers in it, but you just go ahead and replace those out with your own, basically. Right. So you'll put your put your revenue, base year revenue number in at the top. If you're using the 4.1%, that's already accounted for through the center. Then it'll actually generate your counterfactual number at that point, and the bottom line, your actual loss number. So it works really slick. The biggest thing is just making sure that your revenue number is accurate. Your revenue numbers, both top and bottom. And still, I keep hearing my senior year calculus teacher from high school, garbage in, garbage out when it came to equations. So as long as your numbers are good and accurate and follow the guidance as far as what's applicable to these numbers, then you'll get the accurate numbers that you're looking for as far as the loss goes.
Thank you, Justin.
You bet. Anybody else? Okay, like I say, please, if anybody's got questions as they're working through this, like Leslie said, the equation looks big and scary, especially if on the instruction sheet that we've got included there, but especially with that calculator that she's got, as long as you're able to derive the appropriate numbers from your own records that you need, you should be in good shape. That's a pretty easy plug and play tool. If you've got questions about whether or not, what parts of your revenue are applicable or not after you've read the FAQs and taken a look at the section and the guidance on it, please let me know, and I'll work to get some clarification, either locally, or I've been in tons of contact with National League of Cities, and they've got some very, very bright people out there that have really been trying to digest these treasury rules and make sure that they have great, an understanding as possible of them, because it's, again, and Auditor Racine said this yesterday, and it made me chuckle just a little bit. You know, we're all working on this project together, but at best we're all sort of making educated guesses a little bit as to the, you know, to some of this, to some of the interpretations of this. We're making our best educated guesses. So we'll keep working together, and we'll keep bringing as much information and education out to all of you as we possibly can. So with that, I will let everybody get back to their Fridays. Thanks for taking a few minutes with us here this morning. If you have any questions, again, reach out to me, and we'll see you next Friday.